Welcome to this explainer. Today, we're diving deep into the massive, high-stakes financial gambles behind global mega events. We're going to open up the World Cup balance sheet and decode the absolute true cost of hosting. We're going to unpack exactly what happens to a nation's economy when the entire globe turns its spotlight their way. All right, let's just jump right in and look at this staggering number. $200 billion. Yeah, you heard that right, billion with a B. That is the approximate amount Qatar spent to prepare for the 2022 tournament. It's a number so huge, it almost loses its meaning, doesn't it? But it forces us to ask a really crucial question about these monumental economic commitments. Which leads us directly to the big one. Was dropping $200 billion actually worth it? In this explainer, we're going to take a really rigorous look at the balance sheet. We're going to weigh a nation's optimistic pitch of total economic transformation against the harsh, everyday realities of actually hosting. So here's our roadmap. First, the multi-billion-dollar pitch. Second, winners, losers, and elephants. Third, soft power and halos. And finally, the future of hosting. Okay, part one, the multi-billion-dollar pitch, bidding as a national development mandate. You see, just raising your hand to bid for the tournament forces nations into massive, pre-committed capital outlays. Just to be eligible, countries have to commit to building state-of-the-art stadiums, upgrading transportation, expanding telecom networks, you name it. And the spending variance between past hosts is pretty wild. Brazil spent about $19.7 billion in 2014, Russia hit around $16 billion in 2018, and South Africa spent $7.2 billion in 2010. Huge sums for sure. But remember Qatar's $200 billion? Taking them out of this historical average completely shifts the scale, reminding us that their spend was just a massive, unprecedented outlier. Now, zooming in on Qatar's preparation spend, it actually topped out closer to $220 billion. That is roughly 10% of their entire GDP every single year leading up to the event. But notice how this breaks down. Only a tiny slice, about 6 to 10 billion, actually went to stadium infrastructure. The vast majority funded a complete, top-to-bottom national overhaul. We're talking the Doha Metro, tram services, a massive airport expansion, a brand new cruise terminal, and major highway systems. To be fair, these giant investments absolutely can trigger an intense short-term economic stimulus and major construction booms. For example, Brazil's 2014 hosting led to massive airport expansions across the country. South Africa's 2010 tournament brought the introduction of the Gautrain rapid rail system, and Germany, back in 2006, generated about 2.2 billion euros in revenue, driven by a surge in tourism and ticket sales that spurred major urban renewal. So there is definitely an initial wave of activity and employment. Moving on to part two, winners, losers, and elephants. We're looking at the harsh reality of returns and the GDP paradox. So once the dust settles and that initial boom fades, there's a pretty wild contrast in who actually walks away with the profits. On one hand, you've got FIFA and its commercial network, global sponsors, media rights holders. They benefit the most financially, pulling in direct revenue streams from ticket sales, broadcasting rights, sponsorships, and licensing. But on the other side, the host's incredibly complicated burden. The host city and the government take on nearly all the massive fiscal risk, dealing with heavy public costs, lingering infrastructure pressures, and the very real danger of a debt trap. To keep things totally impartial here, let's look at the actual data. Peer-reviewed research by economists Matheson, Monig, Fourier, and Santana-Gallego points out that academic econometric studies have often found neutral or even negative short-term GDP effects despite spending booms. We really have to confront this uncomfortable empirical truth. Spending tens of billions doesn't automatically mean actual, lasting economic growth for the host country. And you can see this crucial point perfectly illustrated in Brazil's data. Economists actually call this the GDP paradox. During the prep phase, starting in 2011, quarterly GDP growth was looking good, positive, ranging up to plus 2.3%. But from 2014 to 2017, the period during and right after the event, the growth rate tanked, dropping to between negative 0.1% and negative 2.2%. Ultimately, hosting just did not deliver the long-term economic growth that was promised. Which brings us to a really important and honestly pretty notorious concept. The white elephant. This is an expensive infrastructure project, like a massive new stadium, that has practically zero long-term economic benefit and just sits there, largely unused after the event packs up. Academic studies are almost unanimous on this. These highly specific sports facilities offer very little lasting value, particularly in developing nations that spend heavily on brand new construction instead of upgrading what they already have. Check out this wild example from South Korea. They built a massive 50,000-seat World Cup stadium, and in the entire year following the tournament, it hosted fewer than 200,000 fans across all events combined. That is the textbook definition of a white elephant, a facility just draining municipal resources long after the final whistle. And then, of course, there's the very real danger of the debt trap, $500 million. Think about it like this. If a government takes out a $10 billion loan at 5% interest over 30 years to fund these projects, they're on the hook for over $500 million per year for 3 decades. For everyday citizens, that massive annual bill usually translates to painful tax hikes or severe cuts to public services, both of which, ironically, actively hinder long-term economic development. That takes us to part 3, soft power and halos. This is where we look at tourism surges, brand building, and geopolitical leverage. So, if the economy might actually shrink and you're left with empty stadiums and a mountain of debt, we really have to ask, why on earth do countries still fight tooth and nail to host? Well, we have to look at the intangible benefits. And here is a major bright spot. 60%. Post-tournament tourism rises by an average of 60% compared to pre-cup numbers. This points to a really significant halo effect. The iconic global spotlight of the tournament dramatically boosts a host country's tourism trajectory and global image well beyond the event itself. But beyond just getting more tourists, there's a massive geopolitical dimension here. Nations use the tournament for reputational leverage and global soft power, completely transcending simple economics. Hosting is often a highly calculated geopolitical move. It's used to secure global positioning, to diversify economies, and to deliberately reshape a nation's brand on the world stage. It's essentially a multi-billion-dollar advertisement broadcast to the entire globe. Now, this soft power strategy definitely has a highly debated side. Sports washing is defined as when a nation uses a major sporting event to deflect scrutiny from human rights concerns and obscure internal controversies. For instance, critics heavily applied this exact term to the 2022 Qatar tournament. They analyzed it purely as a mechanism of soft power, arguing that the immense financial investment was used to deflect from domestic scrutiny and essentially rewrite the international narrative. All right, let's head into our final section. The future of hosting, how the model is adapting to mitigate risk. Because of these immense costs and mixed benefits, the rules of the game are actively changing right now. In response to these massive risks, we're seeing a deliberate evolution away from massive capital intensity toward a much more sustainable model. Look at the timeline. In the 2010s, we saw single-nation, capital-intensive hosting in places like Brazil and South Africa. By 2022, we hit what you could probably call peak mega infrastructure in soft power spending in Qatar. But look ahead to 2026, shared hosting with modular infrastructure across the USA, Canada, and Mexico. This 2026 tri-nation model is a real game changer because it practically eliminates that white elephant risk. It features drastically reduced capital intensity. According to FIFA, existing stadiums are going to be used largely in their current configurations, with modifications limited mostly just to field of play requirements. They are completely shifting away from demanding massive new builds, and instead utilizing infrastructure that is already genuinely serving these cities on a daily basis. Which really leaves us with one massive final thought. Is the ideal World Cup host the one that needs to build the least? It's a fascinating, pretty provocative question, but it perfectly summarizes our balance sheet analysis today. The era of the multi-billion-dollar national overhaul might just be fading away, forcing us all to rethink the future of global